Thank you so much for joining us. I'm Josh Bartholomew with Horizon Investments. We know this call came together on very short notice, but we appreciate your time this afternoon. We'll be careful with your time. This is going to be a quick call. We wanted to speak with you all directly today at the end of an incredibly interesting week. We obviously communicate in a variety of ways, but wanted to personally talk through our perspectives on the markets this week, right at the end of the week. We've got three guests with us today in order to do that. I've got Scott Ladner, the CEO of Horizon Investments, joining us. He's going to provide context regarding current global markets in order to help shape perspective broadly. After Scott talks for a little bit, we have Dr. Mike Dixon, our head of portfolio management. He'll speak specifically about the Horizon strategies. As many of you know, we organize in a goals-based framework. He'll talk through gain and protect and spend and give some perspectives more specifically about those strategies and how they've been allocated and reacted in this type of market. And then finally with us is Austin Fitch, our senior analyst at Horizon One, and he'll close with some thoughts about varied approaches to risk mitigation, how to think about them uniquely as you contemplate combining those diverse risk mitigation techniques. So guys, thanks so much for joining us. And Scott, let's dive right into it. It's been a wild week.
It has. Yeah, thanks, Josh. And despite the apparent promotion there at the beginning of the call, I'm just the CIO, not the CEO of Horizon Investments. Robbie still holds that title and will forever and ever. Amen. But that being said, like you said, let's dive right in. And I'm gonna go through some stuff. Hopefully there'll be some things that you're not hearing out there in the media and you're not hearing from other strategists and advisors and money managers. I think we do bring a little bit of a unique perspective to this world. I just want to make sure everybody on this call knows that it really is true. Like during these times, we don't sleep. Horizon is not asleep at these times. We are actively monitoring all the different countries and regions in the world, in the global equity and rate space. We're monitoring all sorts of derivatives markets, foreign exchange markets, credit and commodity markets, and we do all of that in order to try to detect what's driving price action, so we can continue to position portfolios appropriately for us and for your clients. And that's really, frankly, why we've got a staff that's built with expertise in volatility trading, in academia, in quantitative finance, and fundamental analysis. You really do have to have a cross-asset perspective in times like this, and frankly, as CIO, it gives me a ton of comfort to know that we do have all those bases covered when we're looking at like across a global landscape, because you have to really have your hands on a lot of different areas to understand what's going on right now. At 10 o'clock this morning, we had a call with an epidemiologist and going through some of the specifics about where should we be getting information from this about this virus? How should we be getting what data should we be actually looking at? What time series are the ones that are applicable? And how should we look at those things? What is the proper? What's likely time frame for some of the things we're talking about? We spent about an hour and a half on the phone with them. It was super helpful. But that's the kind of stuff that we're doing kind of all the time right now to try to make sure that we have the right set of analysis and the right way to look at the world, because it's fast markets. Fast markets is really, it's where we thrive. So we like it. Not to say we like losses. We like a lot of activity. So I wanted to start though with just a little bit of perspective, and the perspective is important because it has been it's been a really challenging week, really challenging 6 or 7 days. It's felt a lot longer than a week. I'm sure to all of you it's felt a lot longer than a week, but we are back to levels in the S&P 500 that we saw in the beginning of October. So we've certainly given up some gains that we've gotten, but it's not like we've given up massive amounts of time and massive amounts of gains. We're talking about 10-12% all in, and 4 or 5 months worth of gains that were hard fought and that we're not happy to give back. But it's we're not talking about catastrophic types of markets right now. It's been quick, it's been furious, but we're talking about markets basically levels back to October from when we started. Again, just a little bit of perspective. This COVID outbreak is the sixth major challenge that global economies and markets have had since the Great Financial Crisis. We've had the European sovereign debt problem, U.S. downgrade, the taper tantrum, the issues with the Chinese yuan devaluation in 2015, and then most recently the trade war and the the kind of subsequent misstep with respect to the hike, especially in December of 2018. There's a commonality to all of those events and all of those challenges, and it's this: we've had pretty reasonably quick recoveries because the underlying economy, and especially here in the U.S., has remained strong. We've had very strong employment and economic dynamics throughout all of this, throughout these periods. We've also had some fairly coordinated policy responses to some of these episodes, like we're likely to see again here coming up, and we'll talk about that more in a minute. But just one series that I don't think gets quite enough play is the highest frequency type of employment picture we can give you, and it's really just looking at unemployment claims or initial claims of unemployment relative to the size of the population in the United States. And this is a great series because one, the unemployment claims come out weekly, so it's the highest frequency sort of employment data that we can get. And two, it always turns up. Like this employment picture always gets worse before a recession, before every single recession. It doesn't have a false signal in there. And and what you've seen, so the last five and what will be now six challenges of global growth that we've had since the financial crisis. They've all been with this backdrop of really a pretty strong economy and actually a strengthening labor market. That's not different now. We still have a very strong labor market. We've not seen any sort of signs of deterioration there, and that's just not simply the case when we've had catalysts, either whether they be external or internal, that have led to longer and more protracted and worse types of bear markets. Both the 9/11 example and obviously the Great Financial Crisis. We're in the backdrop of a weakening employment picture. They're in the backdrop of a weakening global economy, and especially a U.S. economy. That's just not a picture we've got right now. We've got an economy right now that has that's going to benefit from the lagged impact of lower rates. A Fed easing cycle that we're through, and a global central bank easing cycle that we're through as well. That's a backdrop of actually a strengthening economy and an economy globally that has turned the corner. That had turned the corner coming into January. So this is certainly going to be a hiccup. This is going to be a challenge for global growth, but it's not the kind of scenario that typically plays out into a longer-term, more protracted bear market reaction. Get a lot of questions about this too. Get a lot of questions about, hey, the bond market's signaling a recession. The yields are way down. That's telling you the growth is going to be terrible, and a recession is imminent. And that's just not simply the case. So you can actually take a 10-year yield and you can split it up into different component parts that have to do with what does the market expect about inflation? What does the market expect about where Fed funds is going to be? Where does the market expect about growth? In the United States. And if you do that, if you kind of peel that one yield apart into those different types of components, one thing you can take a look at is what is the market's expectation for growth in the United States. And it's been weakening a little bit. But this last episode, the last 40 or 50 basis points we've seen in decline in the 10-year yield, like 3 or 4 basis points of it is due to growth premium coming down. So the most of the reaction in the 10-year yield this episode, as you could probably guess, is due to term premium, and really that's just a fancy way of saying flight to safety. So the 10-year yield has come down quite substantially. Both largely because of a flight to safety, somewhat because of expectations that the Fed is going to cut rates and actually keep them lower for much longer than people had previously suspected, which we actually think is correct. But it's not specifically due to any sort of growth concerns. So this idea that a drop in the 10-year rate or a drop in yields, broadly speaking, in the United States is forecasting some kind of a recession just simply is a misunderstanding of the math. Okay, so here's some things that you're probably not hearing a lot about that we do think are important. One, probably one of the most important things that's driving this market right now, or not really driving the market, but it's having an impact on how the market is trading, how it's feeling, and has a big thing to do with the size of the moves that we've had over these last 4 or 5 days, is the liquidity environment for the S&P 500 equity futures. So as many of you probably know, S&P 500 futures are the most liquid equity instrument in the world. They are the thing that most institutional managers use to take on and put on and take off U.S. equity exposure. And so the liquidity profile of how S&P futures are trading actually ends up being fairly important to figuring out how much money can actually trade without moving the market, so to speak. What we've seen over the last few years is actually the S&P 500 futures actually deteriorate with respect to liquidity, and this most recent episode is no exception. Anecdotally, one of the traders over at JP Morgan that we speak with was shot something over about 2 o'clock yesterday afternoon, showing saying that the inside market on S&P futures was about 20 up. 20 contracts in futures is about $3 million worth. So if you think about that, if you have more than $3 million to trade on the most liquid equity contract in the world, you're going to move the market a little bit. That's a crazy low number. That there's like 1 or 2 zeros missing from that number versus kind of what it looks like regularly. And so the hampered liquidity environment, which is due to a whole host of things that's beyond the scope of this call, but I'm happy to talk about with anybody that wishes to. That challenged liquidity environment makes it so that not very large amounts of money can move the market a lot and can make it look like things are either way better or worse than they actually really are in reality. Okay, so I want to make sure that everybody understands the liquidity backdrop of this market, at least on the S&P 500 futures standpoint, is a little bit challenged, and that's just the world that we live in right now. We would expect people to transition away from futures and more towards ETFs and baskets of stocks as that becomes more evident, but that's the world we live in right now. In terms of like what's been driving price action, Monday and Tuesday of this week was largely due to systematic delevering, and so these are the strategies that bore quite a lot of the responsibility in fourth quarter of 2018 for the sell-off, and these are things like risk parity strategies, CTAs or trend following type of strategies, volatility targeting strategies, which are popular inside of insurance products. All those things have algorithmic and systematic rules about them that essentially when things start going badly or volatility goes up a lot, they need to delever, they need to take equity exposure down. That was very clearly the case on Monday and Tuesday. And we can detect these types of things not only with sort of internal analysis, but also by speaking with people who are experts in this field, who do excellent work in the field, and kind of give us some insight as to what the likely size of the trades are that are going on. You can also just take a look at how much volume is going through in futures relative to stocks, relative to ETFs, and get a sense for kind of what type of market participant is really driving action. And on Monday and Tuesday, it was very clearly future-driven type of price action, which is very clearly institutional type of systematic delevering strategies. Wednesday and Thursday was a very different type of trading environment. It was not futures-led really. It was more hedge fund delevering. And the way that we can detect things like that is actually looking at baskets of stocks that hedge funds are either very long or very short. You can look at different types of systematic and market neutral factor type of baskets and see really kind of what's moving and what's really trading in terms of volume. And so just Wednesday and Thursday was more about basically hedge funds taking leverage down, taking gross exposure down, and just trying to basically getting out of the market. You're seeing the same types of things today, which is gold absolutely getting crushed on a day like this, and actually getting having a bad week overall. And you're also seeing yesterday and somewhat today something that is also a little bit goofy, which is defensive equities underperforming relative to the market and underperforming relative to cyclical equities. That's not the type of thing you would expect to see if there was concerns about global growth. That's actually the exact opposite of what you see. And so that's just a signal again that there's some very specific idiosyncratic price action and trading that is driving some of the activity and driving some of the headline numbers of the S&P 500 level. That is, and people are just creating narratives around that. So so you do have quite a lot of activity underneath the surface that's making index level stuff change, and driving the S&P 500 or driving the Nasdaq, and people are creating narratives around that. CNBC's got to say something. But just know that there are some things going on underneath the surface that are making this not nearly as scary as what the headlines would suggest. Next thing is who's left to delever. From our analysis and from analysis of other folks that we respect and we look at and we talk to, not a lot. Hedge funds are taking exposure down quite a lot. The systematic strategies are at not quite minimal equity levels, but fairly close to their minimum levels. So we don't expect a whole lot of forced selling from here, long story short. Financial Conditions Index. The Financial Conditions Index is something that the Fed cares deeply about. I'm using that to summarize equity market responses, credit market responses, liquidity conditions, all sorts of things that the Fed cares about. They have deteriorated materially over the last 7 days. They've deteriorated about as much as they did during the entire quarter of 2018, the fourth quarter of 2018, but they did it in about 7 days. And so if you want to say, is the Fed likely to react, or is the Fed likely to do something? I would say a week ago I would have said, of course not. What a silly question. Today I would say, of course they are. What a silly question. Because the quickness of the deterioration in the financial conditions and also what is happening in the rate markets is making it so that they don't have a whole lot of a choice. Whether that's good or bad is irrelevant. It's telling you that they are likely to act, and they're probably likely to act as soon as March, which I would not have said a week ago. But that is the state of the world today. Basket of Bernie loser stocks. Just one other thing that is not being talked about a whole lot that we think actually is playing into this some. Don't think it's a coincidence that on Monday, after Bernie's massive win and very strong showing in Nevada, that the stock markets really started to perform poorly. There wasn't a whole lot of extra news on coronavirus over the weekend, but there was a whole lot of extra Bernie news over the weekend, last weekend. And I don't think it's a coincidence that there is that markets really started to have trouble there. The coronavirus is a handy scapegoat, but there is a basket. You can construct a basket of stocks that would be hurt by a Bernie presidency. Those stocks have gotten destroyed this week, and just absolutely decimated. So to say that there is no impact from politics at this stage as we approach Super Tuesday, and to blame everything on the coronavirus is just stupid. And then finally, from a technical standpoint, we're not huge technical guys here at Horizon, but we certainly we know enough to pay attention to it and to kind of know what we're looking at it when we need to. We are approaching, we're at oversold levels, the most extreme oversold levels that we've seen over the last 5 or 6 years. The last couple big ones were Christmas Eve of 18, and what a wonderful Christmas that was, and the Chinese devaluation in August of 2015. That was a big surprise. Those 2 days, those are the two other really large oversold days as of today. We're there, and so at least from a technical standpoint, we are quite oversold, and that historically tends to lead to a bounce. Not saying that it will, but that is a condition that usually once it's met leads to at least short-term stability. Okay, what are we looking for? We are, as I alluded to earlier, we're certainly looking for some global central bank activity. Kevin Warsh is out in the Journal as a former Fed governor overnight, making the case for globally coordinated central bank activity. Context that we've got, I think that is not a terribly likely outcome. Whether it's a good or a bad idea, I just don't think it's a terribly likely outcome. But possibly a coordinated statement would be something that we get over the weekend from central banks around the world, and just think of the form of something like, hey, we the Fed and the ECB and the BOE and the BOC and the Bank of Japan and whoever else, we're all watching this. We're all prepared to act. We have kind of our finger on the trigger, but just know that we're all ready to act in coordinated fashion when and if we need to in order to support the economy and support growth. A statement like that would probably help. Whether or not you think that the Fed cutting rates or any central bank doing things would actually matter to the coronavirus is somewhat irrelevant. I would say it is really the fact that this would end up helping, certainly help sentiment and help give a pause to people that want to continue to sell into this. I said earlier that we were on with an epidemiologist this morning. And just kind of basically trying to figure out what do we need to look at from the testing and what sort of data we need to find. Probably one of the most important things that you're not going to hear is this idea of a serologic immunity test from that the CDC has distributed worldwide, and especially in Wuhan, China. The point of that is to essentially figure out how many people have been exposed to this virus and developed some sort of internal immunity to it. So in other words, how big is the denominator in the number of people that have died versus the number of people that have contracted the disease? Right now, we know that there are somewhere around 80,000 people that have contracted the disease, and it looks like the death rate is somewhere around 2%. But if 1 million people have contracted the disease, and just a lot of them aren't showing symptoms, or they show such mild symptoms that they don't go to the hospital, maybe that fatality rate is 0.1%. If that's the case, this is a very different story. We're talking about the flu in a developed country, and the economies have functioned for quite some time with the flu. So, I'm not trying to downplay the humanitarian aspect of this, but it may be the case that this is not quite as serious a thing as people are making it out to be right now. We just don't know yet. But data from this test is something that we're going to be looking for in order to figure out what the correct denominator is in that death over infected ratio goes. We're also going to be looking for, I won't belabor this, but we do a lot of work on these ideas of systematic strategies and whether the market is hedged or not hedged or overhedged or what's overreacting, what's underreacting. We're going to be looking for a lot of that kind of stuff. We're going to be continue to look under the hood of the equity markets and examine, we think it's really interesting and very important, frankly, that emerging markets have outperformed this week by a lot. The China equity market, the epicenter of this entire outbreak, China's up on the month and up on the week in their equity markets. That should be not taken lightly. Where this thing all started, it may be fully priced in, the damage of it. And so that's something that we're going to be examining, and we're also going to be looking at some of the performance, some of the market neutral factors in the equity space, try to gauge on, and the reason for that would be to try to get a gauge on how likely it is that hedge funds would continue to have to delever. And then finally, we are certainly looking at politics. I don't think that, I'm probably not surprised that we do think that Bernie ascendance has had something to do with this reaction. How he does on Saturday in South Carolina, and certainly how he does on Super Tuesday. Is there any chink in his armor, and is there any way that he's not going to get the nomination? You can go both ways on that. If he's the nominee, then Trump's certain to be elected. That's probably the right case. But if he's the nominee, there is a chance he's elected, and that's something that you can't, and I don't think the market would discount. So I'll end my piece there. That is sort of what we have seen, why we're actually still pretty positive on this stuff right now. Having looked through it and kind of seeing what's going on underneath the covers, and giving you an idea for what the types of things that we're looking for going forward.
Scott, thanks so much for that insight. Super helpful, especially at the end of a tough week. I did have your title correct, but the team asked me to make sure you were still on your toes at the end of the last week, so I'm glad you caught that. But we gave a lot of information there just for our audience to know. We're not going to do Q&A today, given the size of our audience, but I will give some instruction at the end on how to do that, should you have follow-up questions for our team. With that, Mike Dixon, I just want to hand it over to you to talk with the backdrop Scott just gave, talk maybe some specifically about strategies at Horizon Investments. We talked earlier about gain, protect, and spend. Why don't you give us some perspective specifically on those strategies in a week like this?
Yeah, sure. Thanks a lot, Josh. First, I want to talk a little bit about, our gain suite. And our gain strategies are really focused on the objective of accumulation. And so I want to, discuss this in terms of kind of the broad allocations that we pull there, and really what allocations are driving differences among portfolios this year and this week more specifically. And, so at Horizon, we do invest globally. So, while U.S. stocks were actually way ahead of international stocks as much as 6% year to date, even just 10 days ago, that gap has nearly closed at this point, now within 1% to 2%. And what this means is that regional allocations will create little separation between products kind of for the year, whether or not they have just domestic exposure or whether they have a lot of international exposure. However, more recently, they would have created quite a wide separation in returns. And interestingly enough, when we look inside international markets, and Scott, you mentioned this as well, emerging markets in China have acted actually in a very defensive manner as U.S. stocks have fallen this week. So, what that means is where the coronavirus fears started, in China and emerging markets, that's actually held up very well more recently. And so, looking inside there, larger allocations to emerging markets recently would have really helped performance and dampen volatility. But year to date, again, not really providing too large of a separation, as you have globally a lot of these returns kind of converging. And I think that points a lot to the chop we've seen this year from a regional level. Now, looking into some of the broad styles that we look at, like growth and value, we continue to see U.S. growth really behave kind of in a defensive manner, and that's actually a pretty interesting trend. We think this is likely due to the general trend of really growth being in demand, therefore kind of pushing up prices of those more growth-oriented stocks relative to value stocks. And so, again, what's driving differences in returns for the year? Well, year to date, that growth value spread in the U.S. still sits at about 5 or 6%. So while global exposure might not drive big returns, separation in returns this year, growth versus value certainly will, in favor of a tilt towards growth. And then when we look into kind of small and large cap, another big style that we invest in here, we've seen a top-heavy kind of narrow trending market, kind of consistent with that growth over value trend that we've seen. Therefore, small caps again haven't really kept up with large caps this year. We've seen this week, day to day, that be quite choppy, but the trend still appears to hold that from an allocation perspective, an underweight to small caps is going to be beneficial in equity portfolios. And so let me also talk about the fixed income market as well. Of course, as this is going to relate largely to risk-based allocations, whether it be a conservative a horizon model, moderate model, or focus model. And in fixed income, you've got broad investment grade bonds and treasuries up nearly 3% on the year. And really, as expected, really long duration treasuries have done very well. And so specifically, you've got long treasuries are up by about the same margin that stocks are down. And so when you look inside portfolios, portfolios with overweights to duration are really going to have a pretty large separation in the fixed income space because of that. And then when we look kind of at credit risk, while you have high yield bonds, for example, down about 2% on the year, actually, zooming out a little bit, given the drawdown we've seen in the equity market, they've actually held up pretty well. And so high yield bonds down about 2% on the year, with most of that being this week, as compared to about positive 3% for broad investment grade bonds. But if we look at just a little bit higher up the credit spectrum at, investment grade bonds, because of the duration component in broad investment grade bonds, you've still got those credit markets actually still keeping up with the broad fixed income market, up nearly 2% year to date. So again, in the fixed income space, what this is going to mean in risk-based allocations is you're likely to see a pretty big spread in returns across risk-based models because of those realizations. And so, Austin, I know we're going to bring you in here in a second, but based on all that stuff I said there about the gain suite and allocations, anything you'd like to add?
Yeah, no, Mike, what I would say is you hit on a number of different levers that maybe we pull within an accumulation-focused portfolio. And I think one thing to highlight just broadly across whether it's equity or fixed income is this idea of a global flexible approach. So again, whether that's you're looking at equity securities or fixed income securities, having that flexibility to make the growth value decision or to make the domestic international decision, which we here at Horizon have that flexibility, I think in a time like this is only additive to the process from an investment management standpoint. And again, whether that's Horizon proprietary strategies or for those folks on the phone who are maybe managing their own models, that idea of flexibility is extremely important in a time like this when you do have volatility in the markets, to be able to make shifts within an underlying portfolio, whether it's through active management or through changes in the portfolio, can be very important.
Yeah, thanks a lot, Austin. And I want to talk a little bit about our spend stage before we go over to the preservation stage, which is probably what's on most folks' minds this week. And in our spend stage here at Horizon, we're really designing these strategies to support specific distribution rates. And we do that by using a number of components and a rebalancing mechanism in one of our strategies to help minimize sequence risk and help ensure there's liquidity available in those portfolios. The first of these components is an asset allocation that's matched with the desired spend rate. And what that looks like is less equity exposure, the lower the spend rate, and higher equity exposure, the higher the spend rate. And then the other two components of the process are really meant to shine specifically just in volatile markets like we've had. The second of these components, this idea of a spending reserve. Many of you that might use our real spend strategy are familiar with this, but this is an allocation invested in 3 years worth of the desired spend rate for the model, and invested in short-term investment grade bonds, treasuries, and cash-like instruments. And the purpose of this is to provide liquidity during down markets and help mitigate shorter-term volatility. And these allocations have done exactly what they're supposed to do in this drawdown, and that's retain their value. So again, in real spin portfolios, you've got a spending reserve that is meant to retain its value, and that's exactly what it's doing. And third major component here, the risk assist strategy, a risk mitigation component meant to mitigate risk for catastrophic markets. Now, in real spin, most real spin models will not have much risk assist interaction at this point, but if markets continue to head south, they will. And so really, in summary, even during a lot of volatility and quick drawdown like this, our real spin process was already designed to weather these types of markets. So we don't need to make a change to the process or anything. This is what it's built for, and it's really working kind of as designed. And so I'll say a couple words about this slide, Austin, before turning it over to you to talk in more detail. But, in our protect stage, we really like to highlight the fact that we use a diversification of risk mitigation techniques. And I think that's really important to highlight, especially during this type of market volatility. This diversification of techniques should really provide a smoother path through all types of volatility. And so just a couple words about each of these categories here. A risk assist type strategy is built for catastrophic markets, really designed to change the stock and bond allocation over time. You've also got option strategies that may use derivatives to help mitigate risk, but do so with minimal interest rate risk, right, without the use of bonds. And this should really help provide a high level of consistency during down markets. You've got also managed volatility strategies, which really rely on stock selection to tilt towards more defensive equities that are generally more stable during market drawdowns. And then finally, this fourth category here, multi-asset strategies that really rely on asset class diversification and are really meant to have a positive correlation to interest rates and should perform quite well when bonds do. So, Austin, I know there's quite a few things you wanted to talk about as it relates to use cases here, so I'll turn it over to you.
Absolutely, and thanks, Mike. What I would say, and you hit on it just a second ago, is this idea of diversification across the protect phase or the preservation phase when it comes to a client's objective. And I think, Mike, you hit on really four major types of preservation strategies. And what I would say is it's really important to understand the focus within each type of strategy. So as you can see in this table, strategies like a managed volatility strategy or low volatility, it's often referred to in the marketplace, or a multi-asset strategy are maybe more appropriate when markets are kind of choppy or moving sideways, right? There's not necessarily one going one direction or the other. There's not really a trend per se in that market. And those strategies tend to perform really well in those market environments, and they protect against those types of strategies. However, that's obviously a little bit different than what we've seen over the last week or so, right? You've actually started to see a market pullback. That's where I would say, and Mike touched on this, you start to get into more of a catastrophic market protection, but also a market where option strategies maybe offer a little bit more protection. Option strategies, specifically if you're looking at option collars, for example, can oftentimes really fill that kind of medium-sized drawdown, if you will, where it protects to a certain point, and then you start to experience losses past that point. You can see, a good example is maybe anywhere down 5 to down 20. Again, we're within that range right now, but obviously there's risk of catastrophic markets, and I think we would all agree that the risk of catastrophic markets today is maybe higher than it was a week or two ago. And that's where a strategy like risk assist or more of a tactical shifting allocation is maybe most appropriate, where there is the possibility of a 25, 30, 40% drawdown. That's a 2008 scenario, which again, I know none of us would ever hope for that to happen, but that type of catastrophic protection is where a strategy like risk assist is really built to address that type of market, whereas other types of preservation strategies are built to address other types of market drawdown. So the one takeaway from this whole slide and when thinking about preservation strategies in general is really to understand the specific strategy you're using and how it's being used within a portfolio. So within Horizon proprietary product, there's oftentimes multiple uses of different types of strategies, and the combination thereof really seeks to address multiple types of market drawdowns. I would say for folks that are using either Horizon product or Horizon strategy as a part of a more broad allocation with maybe multiple managers or multiple strategies, you want to make sure you're understanding which Horizon product or strategy is being used, the role that it's playing, and that the role and of other strategies in the portfolio, to make sure that you're complementing one another rather than exacerbating any problems and maybe leaving the portfolio exposed to certain market drawdown scenarios that you could otherwise seek to protect against. So with that being said, Josh, I will turn it back to you to close us out.
Yeah, thanks, Austin. And guys, thanks for ending on this protection set of strategies. It's obviously a place we've done the majority of our most recent research and development. So a lot of what we have that's new fits into these categories, and a lot of the existing strategies that are some of the most popular fit into this risk or the protect series. So appreciate you guys giving a little bit more context there, and certainly Scott also the broader perspective on global capital markets. Really helpful at the end of a volatile week like this. I want to thank all of you for joining us today. Again, I know that it was kind of a last minute thing, but we appreciate your interest, your time, and the confidence that many of you have shown our firm. We hope this has been helpful. We're going to continue to communicate normally and as needed in times of market stress like today. Be sure to use our online tools. There's a lot of information, and I think those tools are very, very helpful in a time like this that you can access at our website, horizoninvestments.com. You can also read much of our content there. We're also on social media outlets such as LinkedIn and Twitter. Most importantly, if you have questions or concerns, hopefully you already have a contact here that you can reach out to. But if you don't, if you're new to Horizon, you can email at sales@horizoninvestments.com, or certainly you can call us at 866-371-2399, extension 202. So with that, we'll let you go. We look forward to hearing you, serving you through the rest of this year. And guys, thanks so much again for joining us. Have a great day.